equity funds, their main objective is to invest in those companies which are listed in Nairobi Stock Exchange, while fixed income funds, their main objective is to invest in fixed assets. These fixed assets include government bonds and also corporate bonds. If we were interested to find out the clear definition or the clear difference between an equity fund and a fixed income fund, then I believe I've done a decent job. And if that's what all you needed, then you may just leave. But if you are interested in this kind of content, remember to subscribe, like, and also don't forget to share. Now, my main objective is kind of to give a clear understanding what it means to invest in an equity fund and also what it means to invest in a fixed income fund. I believe this video is going to be somehow long, but at the end of the day, I believe I'm going to do a decent job. Now, what are the benefits of you as an individual going ahead and investing in or with equity funds? Equity funds are managed by professionals. So, by the fact that you have decided to give out your money to those professionals to manage your resources, then it means they are going to take much caution when it comes to selecting those companies which are listed in Nairobi Stock Exchange, and they are going to do a decent job when it comes to that. So, for those individuals who have no idea or they have limited time when it comes to researching their own stocks, then investing with equity funds is one of the most appropriate way which you can ensure at least you minimize some of the losses which you may incur once you have started investing in Nairobi Stock Exchange. Now, once you have started investing with equity funds, another benefit which you are assured is you are going to grow, or your resources or your assets are going to appreciate as the Kenyan economy also continues to progress. That's the benefit of you as an individual, ensuring that you are invested with equity funds. As the Kenyan companies tend to grow with time, you are also assured that those benefits you are also going to reap them. Another benefit of you investing with equity funds is you are assured that there is a diversification. By you purchasing shares in an equity fund or investing your resources with an equity fund, the fund managers are going to ensure they have diversified their portfolio. And you as an individual, you have just bought one equity fund, but they are going to buy various companies or various bonds which are available in the market, and you are going to realize benefits or the averages which these equity funds are going to reap from the market. That's another benefit of you investing with equity funds. We have said that you are going to be assured that these funds are managed by professionals, and the growth of the Kenyan economy is going also to be reflected in your assets. At the same time, you are assured that your wealth is going to grow. We understand that investing in stocks, you are assured you are going to beat inflation, and it's one of the best platforms for you as an individual to build or to create your own wealth. So that's another benefit of ensuring that the resources which you have put in an equity fund, they are going to grow over time. So you don't have to worry. Now, we need to discuss the whole issue of an equity fund. An equity fund, you can decide to invest on a regular basis. For example, you invest once in a month, you subscribe once in a month to that equity fund, or you can invest a lump sum of resources. For example, you have won a jackpot. You can go ahead and invest the whole amount in that equity fund, which is going to ensure that over time it's going to grow as time goes by. Now, who are individuals who are supposed to invest in equity fund? First of all, before you invest in any given equity fund, you need to realize how you as an individual are going to react to various market scenarios. We understand there's a bull market and also there's a bear market. A bull market is whereby your stocks, or if you have decided to go individually, to select your own stocks is whereby those share prices tend to rise, and they do rise so quickly. And also the opposite is when a bear market happens. Those stocks tend to collapse so quickly. So you need to realize, are you kind of aware that this is going to happen? If you are aware and you are strong that you are going to sustain the storm, then investing in equity funds should be one of the main objectives you may consider when it comes to your investment strategy. The time horizon which we are going to stick with that equity fund, we need to realize that if you are going to stay with an equity fund for less than 1 year, then you may as well invest in a money market fund or a treasury bill, a treasury bill, yeah, because we understand that equity funds are so volatile. The stock market is so volatile, and as we have said, equity funds in Kenya, over 60% of the resources which an equity fund has are supposed to be invested in stocks. Others they may invest, for example, in bonds, with certificate of deposit, whichever they may get interested to invest in. But it's required that over 60% of the resources they be invested in stocks, and the stock market is so volatile. So if you are going to invest for a short period of time, by that time you may require your resources, you may find that the stock market is down, and you may end up making huge losses if you were invested in an equity fund. So if you are interested to invest over a short period of time, choose different avenues which are going to ensure you don't incur losses. What are your financial goals? So as an individual is going to invest in an equity fund, your main objective should be you want to build wealth, you want to create wealth. For equity funds, it's not appropriate for you to invest some of the resources, maybe your retirement savings in equity funds. Those are not the best alternatives for you to use when it comes to investing your retirement resources. So your goal should actually enable you to decide whether you should go for equity funds or fixed income funds. Another thing which you should consider is your financial health. If you don't have an emergency fund available, then you should not go ahead and invest in an equity fund. If you have some debt, you should not go ahead and invest in equity funds, because first of all, if you find an emergency in abrupt, you may go ahead and need some resources which you have already invested in equity funds, and you may withdraw those resources when it's a bear market, and you may end up making huge losses. And why you should not invest in equity funds if you have some huge debts is there are debts which have higher interest. For example, they have more than 20% in terms of interest which you are going to pay. And when it comes to the stock market, on average, it has been returning 10 to 20, not 10 to 12% or 8 to 12% on average. So it means the interest which you are going to gain from the equity funds is not even going to service your interest even in a half. So that's why if you are not in a good financial health, you should not invest in equity funds, or you should find some ways which are going to limit the growth of your health, and then which you are going to ensure you have a decent growth when it comes to your financial health and the investment which you are going to make in equity funds. Another thing is discipline. You need to realize that if you are going to invest in equity funds, as we have already discussed, the stock market is so volatile. And if it's so volatile, if you don't have the discipline of investing consistently, of staying or sticking to your goals, no matter what, when it comes to the stock market, then you are likely going to make so many mistakes when it comes to equity funds. You may end up seeking your cash when the market is down, and this is going to make you a lot of losses. At the same time, you may end up going back to the stock market when the share prices are so high, and you may end up making also a lot of losses. So if you are going to invest with equity funds, stick to the discipline which you are trying to follow. Now, we need to move ahead and discuss what are fixed income funds. As I have said in the other introductory part, I said that fixed income funds, they mainly invest in fixed assets. These fixed assets include, we said, government bonds, and also we have corporate bonds. Now, there are some benefits which are related to fixed income funds, and those are the ones which we are going to discuss. And also, we are going to discuss some of the challenges which are associated with fixed income funds, and we are also going to see what you should go ahead and do if you are interested to invest with fixed income funds. So, as we have said, fixed income fund is whereby you as an individual, you decide to give out money either to the government or to a corporate, and in return you are assured of a fixed interest, and by the end of the agreed time frame you are going to be given back your principal. So that's the main goal of you investing with fixed income funds. But now, for fixed income funds, you don't go ahead and pick those bonds individually. By you investing with fixed income funds, you reap that responsibility to those fixed income funds. They are responsible to go outside there, research on the appropriate bonds which they are going to invest with, and then you as an individual, you are going to be given back, or you are going to be rewarded in terms of dividends or interest, and by the end of your agreed time frame you are going to receive your principal back. And now, what who should invest in fixed income funds? So as we have said, every individual should actually have, if you have an equity fund, you should also have a fixed income fund. And why is it so essential? For example, as we have already discussed it in the fixed income funds, there are situations where you find that the market is the bear market. That is, the stocks are doing so badly. For you to limit the chances of you going to make some erroneous mistakes when it comes to how you react or you behave, it is essential to have a portion of your wealth, a portion of your resources or money be invested in fixed income fund, because you are going to be assured of interest, and this will prevent you from going back to the equity funds and making some withdrawals which are going to ruin your potential or your chances of you succeeding in equity funds. So most individuals, especially if you have enough resources and you tend to conserve some of your resources which you have, and also to grow some of your resources, you should have an equity fund and also a fixed income fund. Now, as I've said, equity fixed income funds are required, or you require, you as an individual, you are in good financial position to invest both in equity funds and fixed income funds. But specifically, who should invest in a fixed income fund? First of all, those individuals who are conservative investors, they should invest with equity funds. These are individuals who cannot actually stomach watching their own resources dwindle. I need to give you a brief kind of an example. During the 1929 market depression, the stocks lost 90%. Some of the stocks lost 90% of their value. For example, if you bought a stock at 100 shillings, that stock would end up selling at 10 shillings. That's how brutal the stock market is. So if you are a conservative investor and you don't want to go through the same case scenario, then you should go ahead and invest in fixed income funds. Also, during the Great Recession, or I can say in the 1990s, 2000s, the stock market lost 60% of its value. If you had invested 100,000 Kenyan shillings in the stock market in the US, then by the end of the day, during those worst moments in the recession in 2000s, you could have amassed a massive 40,000 Kenyan shillings from your 40,000 Kenyan shillings which you invested in the stock market. So if you don't want to experience the same brutal experience, then you should go ahead and invest in fixed income funds. And another individuals who should go ahead and invest with fixed income funds are those individuals. Why am I kind of confused? So, as I've said, those individuals who want, and if you are an old person, then you should go ahead and invest actually in fixed income funds because you are assured of an interest and also you are assured of your principal back. Now, what are some of the examples of available fixed income assets? Yeah, what are those examples of fixed assets? We have treasury bills, and treasury bills they mature within 1 year. That is, if you are going to invest, let's say 100,000 Kenyan shillings, you are not going to gain an interest on that amount, but you are going to purchase this treasury bill for less than 100,000 Kenyan shillings. But by the end of the maturity of that treasury bill, you are going to gain the exact amount, that is 100,000 Kenyan shillings. If there was an treasury bill which was giving out an interest of, let's say, use a good simple example of 10%, then you are not going to pay the whole amount of 100,000 Kenyan shillings. You are going to pay 90,000 Kenyan shillings, and by the end of the year, you are going to be given back 100,000 Kenyan shillings. So that's how treasury bills behave. We have another type of fixed asset which is treasury notes. Treasury notes they mature between, let's say now, 1 year to 10 years. But here you are going to be given an interest, and this interest is either going to be, most of the time it's going to be semi-annual. That is, every after 6 months you are given an interest. Let's say if you invested 1 million Kenyan shillings, and the interest which was agreed upon on that principal is supposed to be, or the coupon is supposed to be 10%. Now you are supposed to receive 100,000 in terms of the interest per annum. So by the end of the year, but after, if you have bought, let's say now, after 6 months, you are going to receive 50,000 Kenyan shillings, and then after another 6 months, you are going to receive another 50,000 Kenyan shillings, and by the end of the day, you could have received 100,000 Kenyan shillings in terms of the interest, and this is going to be going ahead year after year until you reach agreed time frame. If it was 10 years, then you are going to receive an interest up to the final year, after which you are also given back your principal of 1 million Kenyan shillings. Now we have said treasury bills, we have treasury notes, and then we have, we have treasury bonds. For treasury bonds, they mature, or they take a time frame of around 20 to 30 years. So if you are going to invest 10 million Kenyan shillings, you are going to receive 1 million every year until you cover those 30 good years which you have decided to fix your resources in a fixed income. Now, we are going to discuss what are some of what's the remaining objective, what are some of the benefits of you as an individual investing in fixed income funds. Number one, you are assured of the interest or dividends. You are assured. You are not an owner of that of that business. I say, if it was given by a corporate, you are not an owner. You just lended money to this institution. So one thing which you are assured that you are going to receive your principal back, and at the same time you are going to receive the interest. Now remember, fixed income funds are responsible for investing in those corporate or government bonds. So they are given those dividends, and you as an individual, they distribute the dividends as you deserve to you as an individual. So you are assured of receiving interest and also your principal back as time requires. Another thing which you are assured of when it comes to this fixed income funds, there is no that volatility. It's not that massive. You can't compare it with the stock market or the equity fund. So when it comes to volatility in the fixed income funds, they are not volatile. But if it was the equity funds, the opposite is true. Another thing is you have a higher claim when it comes to the assets of an institution, for example, you invested with. But remember, here we are using fixed income funds, so they have a higher claim. Let's say if they have invested in corporate funds, for example, Safaricom, and Safaricom is almost collapsing, so they have a higher chance to claim the assets of Safaricom compared to their common shareholders. So that's another advantage of you investing with equity, not equity but fixed income funds. Another advantage, no, we have already discussed it about the advantages. Now, what are the disadvantages? We have lower returns. When it comes to the investing with fixed income funds, they don't invest in risky assets. They invest, as I've said, in fixed assets, for example, bonds. And those, what you are assured is that your principal is going to be back and also the interest which you agreed upon. So there is no massive growth you can expect from fixed income funds. Another thing which you need to realize, there are some instances where though there can be a default, there are some companies which end up collapsing, and if you invested in a fixed income fund which invested in these companies, then you are also going to receive the same treatment. That treatment of you not paying paid your interest and also your principal. And also the investing in fixed income funds is highly susceptible. It's challenging pronouncing that word, but it reacts when it comes to interest changes in terms of interest rates. If, for example, the government is going to increase the interest rate, and your interest which you agreed upon is low, then your fixed income fund or your interest which you are going to gain is not going actually to be that. There's no difference which is going to happen, but a difference will only happen if you decide to get rid of that fixed income fund, because you will sell at a low price. Now, another issue which is related to fixed income funds is that some of the interest which you are going to gain from the fixed income fund, they may not catch up, or they may not go at pace with the inflation. Most of the time, the only opportunity which you have to beat inflation is by you investing in equity funds. But when it comes to investing with fixed income funds, chances of you beating inflation are so limited. So that's another challenge of those individuals who invest with fixed income funds. Now, have I left anything out? I don't think so. And we need to discuss some of what how can you define inflation? Inflation is the pace at which prices rises in the economy. And I was actually thinking of this. There was a time when individuals used to buy 400, I believe it's 400 grams of bread for 30 shillings. But nowadays it's 65 shillings. So that's how you can explain inflation. Anyway, I like your thoughts. If you have watched up to this extent, I really appreciate you. And at the same time, if I made some mistakes, I would like your thoughts in the comment section. If you're interested in this kind of videos, remember to subscribe, like, and also don't forget to share. See you in my next one.